learners, welcome to our session today. It is a continuation of what we started earlier on. Recall in our previous class, we looked at the summary and the main concept that you must always tend to have at any given point to your handling consolidation. That is, of course, group accounts. So, in our class today, I'll want us to look at a question which will cement the whole idea of consolidation. And basically, remember, we are looking at a consideration where the company is being acquired on a piecemeal basis, or rather in this case, term it as a deferred payment, whereby I'm paying a certain amount today, tomorrow I'm going to pay a certain amount. So basically, that is a concept that I want us to handle in this question of ours, where we are looking at deferred cash consideration. Deferred cash consideration. So I'm going to look at this question, we go through it together, and then we'll go ahead and handle it. So I'm going to share the question with us in our screen here. Make sure that you have the question clear so that when we handle it, things will always be very, very easy on our end. Believing that is very visible, this is a question. This is what you are told that on 1st July 2018, Beyond Limited held a number of insignificant investments in equity instruments that do not have a quoted price and are therefore carried at cost. During the year ended 30th June 2019, Beyond Limited acquired a subsidiary company, Horizon Limited, and an associate company, Sky Limited. The draft summarized statements of financial position of Beyond Limited and its subsidiary company as at 30th June 2019 are shown below. So we do have our assets, current assets, total assets, current assets. I'm also given at that point. Additional information, these are what you're told, that Beyond Limited acquired 80% of the ordinary shares of Horizon Limited on 1st January 2019. Look at that case, you're told that Beyond Limited acquired 80% of the ordinary shares of Horizon Limited on 1st January 2019. The purchase consideration was made up of 650 million paid on 1st January 2019 and a further cash payment of 147 million deferred until 1st January 2020. So clearly, at that point, my good students, whatever that we need to identify is the date of acquisition. And the date of acquisition, basically, at this point, you're told that I'm having Beyond, which in this case, we acquired Horizon on 1st January 2019. And look at the mode of payment. The purchase consideration was made up of the cash of 650 million today on 1st January 2019, and a further cash payment of 147 million deferred until 1st January 2020. So I'm having an amount which I'm paying 1 year later after the acquisition. And at this point, you're told that no accounting entries have been made in respect of the deferred cash payment. An appropriate discount rate is 5% per annum. Beyond Limited recognizes goodwill of non-controlling interest using the fair value method. So at this point, first of all, you should understand that I'll be talking of the concept of the present value. I need to determine this cash that you're paying today, the cash that you're paying in 1 year, what is its value today. So basically that will take us to the concept of our present value, which we'll be looking at it. Note 2, the fair value of the assets, liabilities, and contingent liabilities as at 1st January 2019 were equal to their carrying value, with the exception of a machine which had a fair value of 60 million in excess of its carrying amount. This machine had 6 years remaining useful life on 1st January 2019. So the concept of fair value is coming in. Recall in our previous class when you were looking at some of the key elements that you must always tend to grasp, we also talked of something to do with the fair value adjustments. So therefore I'm having an item of equipment which is more than the book value. So ideally we are talking of revaluation gain, right? Which we need to readjust that, right? Then we are told that this machine had a remaining useful life of 6 years. So in this context, we should also be able to know that we'll also be required to determine what the depreciation of that. We'll be seeing our working. Then note 4, these are what we are told that, note 3. Note 3, we are told that the fair value of non-controlling interest in Horizon Limited on 1st January was estimated at 150 million. So that is the fair value of this company, Horizon. Note 4, in June 2019, Horizon Limited sold goods to Beyond Limited for 16 million. So Horizon selling to Beyond. Clearly, you can see Horizon was a subsidiary. I'm selling to Beyond. So definitely you're looking at what? An upstream transaction. Upstream transaction. We talked of an upstream transaction. Half of these goods were still held in the stock of Beyond Limited. On 30th June 2019, Horizon Limited marks up all goods by 20%. So basically that note will take us to what? The concept of unrealized profit on closing inventory. Note 5. On 30th June 2019, Horizon Limited's trade receivables still included the 16 million due from Beyond Limited intercompany owings. However, Beyond Limited trade payables only included 11 million in respect of this transaction, as it had made a payment of 5 million to Horizon Limited on 30th June 2019. So basically at this point, I can clearly see we're having a concept of what? Cash in transit. There is amount which was paid, yes, but it had not yet been recorded in the books of the other company by the time we were closing our year. So that is very important to note. We proceed to the other note here. Note 6. You are told that on 1st July 2018, Beyond Limited acquired 30% of the ordinary shares in Sky Limited for cash payment of 120.5 million, which gave Beyond Limited significant influence over Sky Limited. At that date, a property owned by Sky Limited had a fair value of 50 in excess of its carrying amount. This property had a remaining useful life of 20 years on 1st July 2018. So of course that won't affect us here. Remember, for aspect of associate, only the cost of investment is the one that will be affecting us. Regardless of whatever that you are doing, all other transactions won't be interested with them. Only the aspect of the investment in associate. That is what you must always tend to have in mind anytime you're handling the concept of associates as well. Then talk about note 7. We are told that in the year ended 30 June 19, Horizon Limited made a profit of 56.8 million, out of which it paid a dividends of 20 million on 30th April 2019. Beyond Limited debited the dividends received to cash and credited it to investment. So the effect was done, and therefore at this point we are told to required consolidated statement of financial position as at 30th June 2019. Then look at the marks that the examiner is giving us. Examiner is giving us 16 marks. The examiner is giving us 16 marks. Required was consolidated statement of financial position as at 30th June 2019. As at 30th June 2019. So given such a question, my good students, where are we going to start from? I'll try to squeeze this question here so that you can be looking at it, as much as it will be maybe very small, but I'll want us to consider that. So, given such a question, my good students, given such a question, that is clearly you can see we are dealing with consolidation. And the good thing is that it has also combined the component to do with what? Associate. Remember, we talked of associate, and we said anytime you're dealing with an associate, in this case, this is where the company, the parent company, is owning between 20 to 49% of that investee company. And therefore, for associate, again, whatever that you must always send to over the back of your mind, if at all you are to prepare your statement of financial position, only the investment in associate figure or amount is the one to be considered in your SFP. Nothing else is going to be considered in your statement of financial position. That again, you must always tend to over the back of your mind. So once you have that case, my good students, the key element will be our starting point. Where will be our starting point? So first of all, I want us to have a group structure of this company. I want us to have a group structure of this company. I want us to have a group structure of this company. That will be our first working. I want us to have a group structure of the company. So therefore, looking at our group structure, these are what we should be having. Group structure. Group structure. What will we be having? I'm having beyond limited, which is B. We are acquiring the following: Horizon Limited and what? Sky Limited. That is note 1. Look at note 1. Actually, I'm dealing with note 1, where we are told that Beyond Limited acquired 80% of the ordinary shares of Horizon Limited on 1st January. The purchase consideration was made up of cash 60 million on 1st January 19 and a further cash payment of 147 million deferred until 1st January 2020. No accounting entries have been made on this. Then come to note, the other note, note 6, right? Where we're told that on 1st July 18, Beyond Limited acquired 30% of ordinary shares in Sky Limited. So basically, whatever I'm doing here is basically our structure, whereby this structure of ours will entail 80% of Beyond. So basically, that is clearly subsidiary, right? And the date of acquisition is also very key because it will always be guiding us. We acquired this on 1st January 20. We are given 20. We acquired this on 1st January 2019, right? We acquired this on 1st January 2019. That's the date of acquisition. So basically, clearly you can see that this is what? This is a subsidiary. H Limited is a subsidiary because the percentage of acquisition is more than 50%. Whereas S, Sky Limited, we acquired Sky Limited. We acquired what percentage of Sky Limited? We acquired 30% of Sky Limited. And when did we acquire that? We acquired this on 1st January 2018. Is that what was given in note number 6? We acquired that on 1st July 2018. 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 So that is our group structure. So clearly you can say that this is a subsidiary, whereas this is what? That is an associate. That is an associate, given the percentage of acquisition. Given the percentage of acquisition. Once you have our group structure, the other key element, my good students, should be very key, is for us to consider our what? Our cost of investment. Cost of investment. Very key to consider our cost of investment. So cost of investment, in this case, how much did we spend to acquire the first one, Horizon? How much did we spend to acquire Horizon? Let us all go to note number 1. Beyond Limited acquired 80% of the ordinary shares of Horizon Limited on 1st Jan 2019. The purchase consideration was made up of the cash. So I'm having the purchase consideration. Here I'm having cash of how much? 650 million. Our figures are in thousands. So I'm having 650 million. 650 million. Then again, you are also told that on 1st January, that was what was paid. And a further cash payment of 147 million. So I'm having here deferred payment. We're having here deferred payment. Now, this is my area of interest, which I'll want to insist very, very well. In the event that you're talking of, my good students, in the event that you're talking of aspect of deferred payment, this is what we must always tend to have at the back of our mind. we must always recall the concept of present value. Recall present value in the event that you're dealing with a present value. In this case, of course, you are talking of what? We are talking of a lump sum. We are talking of aspect of irregular amount. And basically, in this case, you are talking of what? Aspect of irregular, meaning that I'm receiving this aspect of amount, irregular, or rather lump sum. We'll always be talking of what? The future value of our cash flow into 1 plus rate raised power negative n. N basically is the number of period. N basically is the number of period. I know you're wondering, Mwalimu, we also do have financial management in FR. That is a concept of deferred payment which I'll want it to stick at the back of our mind. Okay? So once we have this case, the present value, remember whatever that you want to do, you want to determine as much as you are paying this amount in future, how much is this amount worth today? This is what you are going to pay us in future, but how much is that amount worth today? How much is that amount worth today? And that's why you're talking about what? The aspect of the present value. So therefore, how much were we paying in 1 year's time? How much were we paying in 1 year's time? In this case, I'm sharing the question again. In that case, you can clearly see how much was this amount, how much are we paying in a year's time. We are talking of course 147 million, right? So therefore my deferred payment will be 147 million, right? We multiply by 1 plus R. What was our rate given? You are given our discount rate of 5% per annum. So 0.05 raised power negative. How long are we talking about? We are talking of 1 year because I'm paying on 1st January 2020. So basically you are talking of what? 1 year. So raised power negative 1. So clearly that should give us how much, my good students? That should give us how much? And this is a beauty part of it, right? At least you're learning something new when it comes to the deferred payment. When you're talking of the aspect of determining the amount to be paid in terms of purchase consideration. Also, the beauty part of this, when we be talking of share-to-share exchange, you'll also find that it is very, very interesting. So therefore, at this point, what will you be having? First of all, I need to determine of course, our aspect of our present value interest factor. Present value interest factor, I should be talking of 1 plus 1.05, of course, raised power negative 1 times 147,000. In that case, I'm getting 140,000. So I'm getting 140,000. So clearly you can say that the total amount that we use to acquire our subsidiary, Horizon, will be a figure of how much here? This should give us a figure of 790,000. That is what Mwalimu is getting. That is what Mwalimu is getting. We used 790,000 to acquire our subsidiary Horizon. That is, of course, after we've considered the concept of deferred payment. That is very key to note. That is very key to note. Then what about the other company? We also acquired Sky Limited. So how much did we pay in acquisition of Sky Limited, which is our associate? We acquired associate, we paid a figure of how much? We're given 120,500,000, right? 1.5, that was in note number, look at note number 6. On 1st July, Beyond Limited acquired 30% of ordinary shares in Sky Limited for cash payment of 120.5 million, which gave Beyond Limited a significant influence over Sky Limited. So at that point, the total investment that we can talk about here, if we sum up these two, how much will it give us? But in this case, recall, you're looking at what? The aspect of the investment in our investee companies. Talk about investment in our investee companies. So my total investment, the one that you are paying today, Talk of total investment, the one that you are paying today. This is an area that I'll always want us to always be very, very keen. This is an area that I want us to always be very, very keen. For investment today, we can agree that what the company is paying now, because you are told that the deferred payment wasn't recorded, that's what we are doing, what the company is paying today, total amount of investment that you're making today, is how much? We are talking, of course, of the cash that we paid, 650, plus the one that we acquired, the investment company, 120. So the total investment, basically at this point, we should be talking of how much? We should be talking of 650,000 plus 120, 500. This should give us a figure of 770,500. Now, compare that with the investment that you are given in your data, because you'll always be given the investment. In the books, you'll always be given the investment that the parent company is making. So, if you can check our parent company in your statement of financial position, under non-current assets, we had property, plant, and equipment, and I'm having investments. Kindly check investment you are given a figure of how much, if you can confirm. Investment you are given a figure of how much. In that case, if you can squeeze your eyes clearly, I can see investment I was given 774,500. So that is to say that this company had other investments. This company had other investments. This company had other investments. Because you can clearly see my investment in associate and the one in subsidiary, what you are paying now is 770,500. But the total investment recorded there, we had 774,500. So that is to say, my good students, that this company had what? Had other investments. Other investments of how much? 770,500 minus 774,500. We can clearly see that my other investments will be 4,000. So that the total investment, because the total investment that you're having should always tally with what you are given as initial investment in your books. That is a trick. There's a clue that Mwalimu is giving us. That if at all, you're supposed to confirm if the company had other investment, look at what you invested. Like, say, in the investee companies. Compare the total investment in the investee companies with what was recorded. If they are not the same, that is to say the company, if at all, whatever that is recorded is more than whatever investment that you're computing, that is to say that the company had other investments elsewhere. So at this point, you can clearly note our figures. That the investment in associate, I'm having 125. The total investment in our Horizon Limited, I'm having 790,000. And therefore, in this case, this is what we'll be having. Now, after we are done with note number 1, actually in that case, we've looked at our note number 1 and 6 respectively. At this point, we are told in note 2 that the fair value of the assets, liabilities, and contingent liabilities as at 1st January 19 were equal to their carrying value, with the exception of a machine which had a fair value of 60 million in excess of its carrying amount. This machine had a 6 years remaining useful life on 1st January 2019. So therefore, the other key element that I want us to consider at this point probably is the aspect of the fair value. So at this point, you've determined, remember you're going with notes. At this point, you've determined cost of investment. You've determined, of course, whatever that I'll be having. Now, this other element, I'll want us to determine, of course, our revaluation gain and how to treat that. So, this case should give us, assuming this was working number 1, I'm having working number 2. But remember, for exams purposes, you can always do these things very, very quick in your calc. no need of you kind of, you don't have to do all these workings. You can do them directly in your calc. You can do them directly in your calc. So therefore, I need to check working number 3. Basically, that is note number. We are in note number. My concern is note number 2. Look at note number 2. Look at note number 2. So working 3, in this case, we are talking of a revaluation gain. Right? We are talking of revaluation gain. We are talking of revaluation gain. We are talking of revaluation gain. And I want you guys to mark these concepts. So revaluation gain, in that note, I'm told that we had a gain of how much? Revaluation gain, I'm having a figure of 60 million. I'm having revaluation gain. We are talking of 60 million, right? Which is 60,000. On the same case, we are told that this item was estimated to have a useful life of how much? To have a useful life of course, 6 years. So what will be our depreciation on this gain? Depreciation that we didn't charge. So this will be like an undercharge. This will be like an undercharge. Why are we saying that it's an undercharge of depreciation? Because whatever that we considered, maybe at this point, talk about, let me squeeze this down so that we are having it correct. So you're talking of depreciation undercharge simply because maybe at this point our cost was recorded as 200,000, but it was supposed to be 60,000. So depreciation that we charged, we only charged of the book value 200, but this time around the fair value is showing that it is 260,000. So there's an amount of depreciation on this 60 that we hadn't kind of considered, and that is what you want to, that is what you are determining. So therefore, depreciation undercharge will be how much? Depreciation undercharge in this case, we are talking of 60 million. Estimated useful life was 6 years, right? So for the whole year, that will give us 10 million. But recall the concept of date of acquisition. Recall the concept of date of acquisition. When did we acquire this farm of ours? We acquired it on 1st January 2019. And our financial year, you've seen our financial year was ending on 30th June. So therefore, that is to say, if at all my financial year is starting, so therefore that is to say our financial year was starting on 1st July and it was ending on 30th June. For us, we acquired this investment on 1st January 2019. So therefore, that is to say from 1st January, in this case, 2019 to 30th June, how many months are we talking about? We are talking of 6 months. So therefore, the 10 was for the whole year. But this investment was not there for the whole year. So therefore, allowed to compute for the time period that this investment was with us. So therefore, we are talking of 6/12, which in this case should give us depreciation undercharge of how much? 5,000. And we clearly know how we are going to treat that. In our SFP, we are going to determine to take care of the revaluation gain by adding it to our PPE. And in that case, of course, you are going also to do what? To credit our PPE with that charge. So that is say we're going to deduct 5,000 in our PPE as at the end of that period. That will be okay. So once we are done with that note, that should take us to the next note we see. So kindly be marking these points of ours. Be marking whatever working that you are having here. So therefore, in this case, talk about the other element here. That is, of course, note number. I want us to go to note number 3. Let me share this. So go to note number 3. Go to note number 3. What is note 3 telling us? Note 3 is telling us that the fair value of the NCI in Horizon Limited on 1st Jan 2019 was estimated at 150 million. So therefore, that is clearly stating that at this point, whatever that I need to compute is what? Our goodwill. So I'll be required to compute our goodwill here. And remember, goodwill, we said we'll be talking of what? Cost of investment. Cost of investment. Of course, we less our net assets on acquisition. Net assets on acquisition. Net assets on acquisition. So this is working number 4. We less our net assets on acquisition. So that will be easy again, because whatever I'm required to do here, my good students, is for us to identify our cost of investment. Because remember, we are talking of full goodwill, right? Remember, we say that in the event that the examiner hasn't, or rather the most preferred one according to IFRS number 10 is always what? The full method of goodwill determination. We talked of partial and full. So cost of investment in our subsidiary, how much did we have? We have determined it here. We had computed this one to be 790 million, right? 790 million. How much was the fair value of NCI? The fair value of NCI, we are talking of, the examiner had given us how much? 150 million, right? So that as at the end of the day, what will we be having? As at the end of the day, what will we be having? As at the end of the day, what will we be having? That, of course, should give us 790 plus 150 to give us a figure of 940, right? Then consider our net assets. Consider our net assets. Recall the concept of the net assets. We said that net assets, what will we be looking at? In regard to our net assets, my good students, we said, what will you be looking at? Number 1, consider your ordinary shares in the subsidiary. Consider the share premium if I'll be having in the subsidiary. Consider the aspect to do with fair value adjustment. Fair value adjustment, or in this case, basically, is whatever that you're talking about being the revaluation gain. And lastly, talk about the pre-acquisition profit. Pre-acquisition profit. Pre-acquisition profit. Remember, you're just following your notes. Pre-acquisition profit. Pre-acquisition profit. All these are subsidiary data. All these are subsidiary data. I want us to go together and identify these items. So, in our books here, let us all go to our equity under subsidiary equity. Subsidiary equity. Subsidiary equity, which was Horizon, ordinary share capital, I was given a figure format. Take the whole figure, 200,000, believing that you are all seeing that. Share premium, I'm having 50,000. Fair value adjustment, which is our revaluation gain, in this case, we got a figure of how much? 60,000, believing that you had it. Now, key area that I want us to agree is on what? The pre-acquisition profit. Pre-acquisition profit. How will we go about pre-acquisition profit? Kindly let us all go to note number. Let us all go to note number 7. Let us all go to note number 7. Look at note number 7. In note number 7, what are you being told there? In the year ended 30th June 2019, Horizon Limited made a profit of 56.8 million, out of which it paid a dividend of 20 million on 30th April. Beyond Limited debited the dividends received to cash and credited it to investments. So in our pre-acquisition profits, my good students, whatever that we are looking at, and remember I talked about that in the previous class, for pre-acquisition profit, we want to look at the profit that this subsidiary had before it was acquired. The total profit since subsidiary started up to the point we were acquiring this subsidiary. So how will we go about it? If you can go with me in our statement of financial position there, under the retained earnings, that is of course under equity and liabilities, retained earnings for the subsidiary, we can clearly see we are having a figure of how much? 502,540, right? Believing that you're able to see that. 502,540, right? Then what about the item that we had during the year? The profit for the year, remember this was 502 was inclusive of the profit that we had for the year. And in note 7, we are told that the profit for the year, we had 56.8. Out of the 56.8, we paid dividends worth how much? 20 million, which our figures here in thousands. 20 million. So this is what you are saying, that we had 502, 540. This was the retained earnings for the whole year, for the whole period since we started. That was the retained earnings. At this point, during the year, we made 56.8, and we paid how much? We paid 20,000 as what? We paid 20,000 as our dividends. My good students, so can you agree that we can determine the profit for the year being 56.8 minus 20 million? Can you agree like that? That the profit for the year then, I'll be having whatever that we made for the whole year, we less the amount that you are paying as dividends. We less the amount that you are paying us, we less the amount that you are paying as dividends. So that as at the end of the day, that should give us 36.8. That is for the whole year. But the question is, when were we acquiring this subsidiary? We were acquiring this subsidiary on 1st January 2019, which was mid the year. So therefore, whatever that I'm having here, if at all this will give us a profit for the year, I need to multiply that one by 6 over 12. We need to multiply that one by 6 over 12 to give us how much? Times 6 over 12. Times 6 over 12. So we can agree and say that the profit that was acquired, the profit that this subsidiary had before acquisition, we should be talking of 502, 540 minus answer, I'm getting 484, 140. So therefore, in this case, you are talking of 484, 140. 484, 140. That is taking the profit for the whole year, the retained earnings since the company started. We deduct the clue that the examiner had given us, the profit for the year, and this was not for the whole year because we acquired it mid. We multiply by 6 over 12. So if we have that, you can agree and say that the pre-acquisition earnings, the earnings that the subsidiary had before we acquired it, we had 484, 140. That is what you're terming it as what? Pre-acquisition profit. So that as at the end of the day, what will we be having? I should be having 484, 140 plus 60,000 plus 50,000 plus 200,000. My good students, I'm getting a figure of 794, 140. So confidently, being our net asset, I can come and confidently state that my goodwill, therefore, our goodwill, therefore, we should be having 940,000 minus answer to give us 145,860. 145,860. That will be our goodwill. That's the goodwill that Mwalimu is getting. So make sure that in the event that you're not getting the concept, you can always get in touch and will always assist where we can. Will always assist where we can. So that's the first, that is a goodwill computation, what you are required to do. That's a goodwill computation, what you are required to do. Now, let us proceed to note number. The other note, it will be which note? I'm sharing the question with us here. Let us proceed. That should be note number, so we've dealt with note 3. So, talk over note 4. Note 4, talk over note 4. What will we be having in note 4? So note 4 here, we are told that in our note number 4, we are told that in June 2019, Horizon Limited sold goods to Beyond Limited for 16 million. Half of these goods were still held in the stock of Beyond Limited on 30th June 2019. Horizon Limited marks up all goods by 20%, believing that you've looked at it. So that is to say that, therefore, that should take us to this note, whereby I'll be required to compute, of course, our, allow me to erase here because you have everything. Remember, like, for exams purposes, you can always do these things very, very quickly. It's only that Mwalimu is taking time so that you should always be able to understand it clearly. So note 4, as you can clearly see, is taking us to the concept of what? UPS. So this is working number 5. Working number 5 is taking us to unrealized profit on closing inventory. Unrealized profit on closing inventory. So how will we go about it? I'm having here, this is, of course, you're talking of an upstream transaction. Horizon, in this case, you're told that in June, Horizon sold goods to Beyond Limited. So, we're having Beyond being the parent company, and I'm having Horizon being a subsidiary. So Horizon is selling goods to Beyond Limited. Horizon is selling goods to Beyond Limited, and in this case, it is an upstream transaction. You can clearly see we are selling goods worth 16 million, which our case is 16,000, right? Because our figures are in thousands. And what were we told? That as at the end of the period, half of these goods were not sold. Half of the goods, which was 8 million, were not sold. And these goods were marked up by 20%. Markup, recall the concept of markup, my good students. We normally tend to talk of what? Profit over cost. We don't have our cost, but you're having our sales. So therefore, that should take us to margin. And margin, therefore, we normally tend to talk of profit of what? Of sales, which in this case, I can't use markup. Markup, we are given a percentage of how much? We are given a percentage of 20%, which is equivalent to 1/5. So we can't use markup because I'm having our sales. So that is to say that we need to convert our markup to what? Our markup to margin. The big question is, do you remember how to convert markup to margin? Converting markup to margin, always have this case. We'll always take our numerator, we add it to our denominator. So like in this case, I'm taking my numerator 1, we add it to our denominator 5. So therefore, we can agree that our margin, therefore, should be having 1/6. So we can agree and say that, therefore, my UPS, we can agree and say that, therefore, our UPS, in this case, we should be talking of what? I should be talking of 1/6 times the goods that were still in inventory of 8,000, which in this case should give us how much, my good students? I'm having 1/6 times 8,000. This should give us a figure of 1333. That is what Mwalimu is getting. Maybe if you're getting the other figure, you can compare. That is what Mwalimu is getting. That is what Mwalimu is getting. So that note was basically about our UPS. We proceed to the next note. What will we be having? The next note, what will we be having? The next note, what will we be having? That should take us to note number. That should take us to note number 5. That should take us to note number 5. I'm sharing this. Look at note number 5. Note number 5, you're told that on 30th June 2019, Horizon Limited trade receivables still included the 16 million due from Beyond Limited. However, Beyond Limited trade payables only included 11 million in respect of this transaction, as it had made a payment of 5 million to Horizon Limited on 30th June 2019. On 1st July 2018, Beyond Limited acquired 30%, so that one, note 6, we've already treated that. So basically at that point, I'm talking of note 5 is all about the intercompany owings, which in that case, it won't affect us here that much, it won't affect us here that much. So therefore, in that case, you'll find that we are done with our notes. Actually, we are done with our notes then. We are done with our notes. So once we have this case, because we know very well that the examiner has requested us to prepare our statement of financial position, what we can do is to prepare and determine the NCI to be reported in our SFP, as well as the retained earnings to be reported in our SFP, so that once we start preparing our SFP, our task will be just copying and pasting on a line-by-line basis. So therefore, these are what we need to do, considering that you're marking this figure for me, UPS, in this case, I've determined it to be 1333. I've marked it there. So these are what we want to do. We want to determine the NCI to be reported in our SFP, as well as the retained earnings of the parent to be reported in our SFP. So that should take us to talk of NCI to be reported. NCI to be reported in statement of financial position, so that our task will remain only to copy and paste. So SFP to be reported in our SFP, I'm having the fair value of NCI. Fair value of NCI, we can clearly agree we have what? 150,000, right? The one that we had computed earlier on, or we were given directly. Then talk about post-acquisition profit. Post-acquisition profit. What will be our post-acquisition profit, my good students? If we had our pre-acquisition profit, can we determine our post-acquisition profit? Yeah? Or simply, remember we're talking of subsidiary, right? This is a pre-acquisition profit. This is a pre-acquisition profit of what? Of subsidiary. Of course, we'll be taking the NCI share. We can have it in two ways. Like in this case, we can use our shortcut. Already I had pre-acquisition profit, and I'm having my total amount here, 502, which was what? Which was post-acquisition, which was the whole bit, the retained earnings as at the end of the period. So of course, having the two, I can clearly determine our post-acquisition, or simply, in this case, we can do like this. We go to note number, let us go to note number 7. So that you say, Mwalimu, don't stop using shortcut. Give us a long way. Note 7, what did we have, my good students? In note 7, we can clearly see that we had profit for the year. Profit for the year, we can agree that we had the 56 million, right? Minus the dividends that we paid. Because recall, from the word go, he said that the date of acquisition was very important. And in this case, we can agree that we acquired this company in between the period, which was 6/12. That will give us our post-acquisition. This will give us our post-acquisition. 56.8 minus 20 million. 56,800 minus 20 million. Times 6/12. That is what we had, times 6 over 12. Of course, we take the share of what? The share of NCI. We take the share of NCI. The share of NCI was what percentage? The share of NCI, of course, in this case was 20%, right? See, because we acquired 80%, so times 0.2. That should give us 3680. 3680. That should give us 3680. The same case, if we could have taken 502, 540, the accumulated profit, we less the pre-acquisition, whatever that we had before we acquired the company, which would have given us 18,400. Right? The same case. Then you take the portion of the NCI, you'll find that it will give us the same thing. Correct? Consider our UPS. Consider our UPS. In this case, our UPS, we're having 1333, the one that we've computed. We take the portion of what? We take the portion of the NCI, which is 20%, 1333.2. 1333 times 0.2 to give us 266.6, which we need to deduct. Recall the concept where we mentioned that we debit the retained earnings. In the event that we are talking of upstream transaction, we are going to debit the retained earnings of the parent, and with the portion of the percentage of the NCI, or the percentage of the UPS, then we debit as well the retained earnings of the NCI with what? That portion of the NCI. Of course, you are going to credit the whole amount in our inventory. And that is what exactly Mwalimu is doing. Then again, we should also consider the undercharge, depreciation undercharge. Depreciation undercharge. Which in this case, we got a figure of how much? We got a figure of 5,000, right? We got a figure of 5,000 being our depreciation undercharge times NCI percentage, 20%. So 0.2 times 5,000, this is what we had. We had already determined that one here. So I'm having, of course, 1,000. I'm having 1,000. Of course, we deduct. So the amount to report in our SFP in regard to NCI, how much will we be talking about here? Of course, we should be talking of 150,000 plus 3680 minus 266.6 minus 1,000, which in this case I'm getting a figure of 152,413.4. That is what I'm getting, what I'm going to report in our SFP as part of what? As part of our NCI. As simple as that. Consider the other value in relation to talk of retained earnings to be reported, retained earnings of the parent, retained earnings to be reported, retained earnings to be reported in SFP, retained earnings to be reported in our SFP. How much will we be talking about? So retained earnings brought forward, retained earnings brought forward, we didn't have. Profit for the year, retained profit carried down. So in this case, we were given the retained earnings carried down, which in this case, we are given what? I'm sharing this. Look at our SFP. Beyond limited, retained earnings, you are given how much? 1,776,260. Look at it clearly. We're given there directly. So therefore, at this point, you can just take retained earnings here. So I'll just take our retained earnings given. Retained earnings, that of course carried down. That one is inclusive of the profit for the year. Retained earnings. We are given a figure of how much, my good students. In that case, of course, I can clearly see we are given a figure of 1,776,260, right? Of course, we are going to less here. We are going to less, of course, not to less, but to add our post-acquisition profit of the subsidiary. Post-acquisition profit of the subsidiary, which in this case, of course, I'll be taking this amount, but the share of the parent, which in this case, I can just do it directly because already we have it there. So we can just take, of course, 56,800 minus 20,000 to give us 36,800. 36,800 by 6/12 times the percentage of the parent company, which is 80%. So times a half times 0.8 to give us 14,720. 14,720. Then, of course, we less what? UPS. UPS share of the parent, 1333 times 80%, which in this case should give us how much? 1333 times 0.8 to give us 1066.4, which in this case you know very well will be required to deduct that. Then I'm having undercharge depreciation. Undercharge depreciation. We're having, of course, 5,000 times 80%, which will give us 5,000 times 80% to give us 4,000. To give us 4,000. So that as at the end of the day, what will we be having as the amount to report in our SFP? I'll be taking, of course, our 1,776,260. We add 14,720. We less 1066.4. We less 4,000. So that should give me 1785, 913.6. So basically, these are the figures that you are going to report. Kindly, you can know them so that we go straight to our SFP. Kindly note these figures. They'll be very, very important for us. You'll find that actually we are done with actually almost all workings, right? If you are in an exam situation where you are supposed to do all the workings, the way Mwalimu was done, it's supposed to take you only 40 minutes. Mwalimu is taking time because I was also considering the aspect of explanation, right? So once we have that in mind, things will be very, very easy on our end. So whatever task that has remained is for us to copy and paste. Believing that you have all these details. So when Mwalimu will be saying, take these details, I know it will be very easy for us to know where we are taking the details. So therefore, allow me to erase this. Allow me to erase this so that we can prepare our SAP confidently by just copying and pasting. That will be your task now. So in this case, I'm having, of course, you are preparing for Beyond Limited Group. So Beyond Limited Group statement of financial position. Statement of financial position as at 30th June 2019. So our task will be just be copying and pasting, right? For exams purposes, you can always start with SFP, insert all the direct entries, because you realize that majority of this data will always be direct. So like in this case, we are having our non-current assets. Non-current assets. We should just take them on a line-by-line basis. We start with PPE. We start with our PPE. We start with our PPE, where in this case, you just be giving me our figures directly, okay? So we start with our PPE. How much did we have in relation to our parent beyond limited I'm having? Let us go together. 1,162,800. We add the one for subsidiary, which is 390. We adjust with our adjustments, where we say that we'll be debiting our PPE with the revaluation gain, which was 60 million. Then we are going to credit that to the figure that we determined, which was depreciation undercharge of 5,000, right? So therefore, that should give us how much? I'm just taking the figures the way we are determining them, right? So I'm taking of 1162,800 plus 321,390 plus 60,000 minus 5,000. I'm getting a figure of 153, 1,539,190. Remember, our figures here are in thousands, right? Then talk of goodwill. We had computed our goodwill, and in that case, you are determining a figure of how much. I know you are taking your notes. Our goodwill, you are determining a figure of how much. Let me check what I've taken a peek. Our goodwill, I can clearly see we had a figure of 145,860. 145,860. Investment in associate. Investment in associate. I think we are determining it when you started. According to our investments in investee companies, we had 120.5. We also realized that we had other investments. We also had other investments of how much? 4,000, right? So therefore, we can determine our total non-current assets. Consider our current assets here. Consider our current assets. Considering our current assets, we are having inventory, right? Inventory, we add them on a line-by-line basis. Inventories, add them on a line-by-line basis. Add them on a line-by-line basis. For parent, I'm talking of 523,600. We add 398,500. Of course, we less the component to do with what? The UPS, where we are going to credit our inventory account by how much? 1333, which we are determined, right? So therefore, we can agree and say that I should be talking of 523,600 plus 398,500 minus 1333, which in this case should give us how much? 920,767, correct? Then we proceed and determine for trade receivables. We proceed and determine for our trade receivables, which in this case we should be having a figure of how much? Trade receivables, just a moment here. Just a moment. I know I'm on the dark, just a moment here. Okay. So trade receivables again, we follow the same procedure, adding them on a line-by-line basis. So trade receivables here. We are having how much? We are having, of course, 41860. 41,860. We add 203,650. We less the intercompany owings, right? Intercompany owings, my good students, I want you to go in, that was which note? That was note number, note number 5. On 30th June 2019, Horizon Limited's trade receivables still includes 16 million. So I less 16 million in our trade receivables. So therefore, that should give us a figure of 41,860 plus 203,650. We less 16 million, which will give us a figure of how much? 589,510. That will give us 589,510, right? Then another form of asset I can see is cash and cash equivalents, right? So cash and cash equivalent, we are talking of how much? 52,600. We add 1,100. We consider the component of cash in transit, which we noted we had, right? We noted we had cash in transit in the same note 5. The beyond limited trade payables only include 11 million in respect of this transaction, as it had made a payment of 5 million to Horizon Limited on 30th June 2019. So I'm having our cash in transit, which you are just going to add there. So talk of, in this case, you are talking of 52,600 plus 1,100 plus 5,000, which will give us a figure of how much? 58,700. So therefore, what will be our total assets? First of all, we start by working out our non-current asset, and that's why I normally prefer working with Excel. It's always very quick. For 1539,190 plus 145,860 plus 120,500 plus 4,000. So in this case, I'm getting 1,809,550. Then 920,767 plus 589,510 plus 58,700, considering that we've done everything, 1,568,977, so that our total assets plus 1,809,550, I'm getting 3,378,527. Total assets. Total assets. I'm having that figure there. Then consider our equity and liabilities. Equity and liabilities. Equity and liabilities. Of course, we should be talking of now copying and pasting our figures directly. Just go to your equity. I'm having ordinary share. We take directly the one for beyond, which I'm given a figure of 600,000. We're having share premium. Share premium, in this case, I'm having a figure, of course, of 100,000. Then retained earnings, talk of NCI. We had computed our NCI. Kindly confirm the one that we computed NCI to be reported in our SFP. In that case, I can clearly see we had 152 for 13.4. I'm having NCI to be, we had computed that one, 152 for 13.4. Then what about retained earnings for the company here? Retained earnings for the company. Retained earnings for the parent. We had computed it to be 1785, 913.6, right? 913.6. After that, consider other liability that we had. Consider other liability that we had. So, we didn't have long-term liabilities, so we have current liabilities, right? We have current liabilities. I'll squeeze it here. Consider our current liabilities. So I'll just have it down there. So we didn't have non-current liabilities, so we'll just talk of our current liabilities here. Current liabilities. We should be having, of course, our trade and other payables. Trade and other payables on a line-by-line basis. 385,200. 385,200. We add 148,500. We less intercompany owings, right? Intercompany owings, that was in note 5, which we had seen. We had what? 11 million. So basically that should give us a figure of how much? 385,200 plus 148,500 minus 11,000 should give us 522,700. 522,700, right? 522,700. Income tax. We're also having income tax there. So therefore, income tax, we should be talking of how much? 53,900. Of course, we add 23,600, which in this case, we should be having a figure of how much? 53,900 plus 23,600. 77,500. And of course, what you must always have in mind is that whenever you're having deferred payment, remember these are liability. This is the amount that you're going to pay in future. So therefore, it is your liability. So therefore, have your deferred payment here. Deferred payment as part of your liability. We had computed a deferred payment. That was how much? We had look at back. We had 140,000, right? Whatever that you had computed. Kindly you can confirm. Kindly you can confirm. So that as at the end of the day, what will we be having here? If at all it's nothing that we've forgot, I should be talking of 522,700. Now, therefore, I can just remove this. You should be having, of course, 522,700 plus 77,500 plus 140,000 to give us 740,200. To give us 740,200. 740,200. So we add all this. 600,000 plus 100,000 plus 152,413.4 plus 1785,913.6 to give us 2638,327 plus 740,200. So therefore that should give us a figure of how much? 3,378,527. to be our total equity and liabilities. Basically, this is what we should be having. So therefore, 3378, 527, 33, correct. So basically, this is how you're supposed to work it out. And I'm going to give you a clue that in the event that probably you are in an exam situation, look at this case. You will realize that some figures here are quite direct. Like PPE, once you have what you have in mind, whatever you're supposed to do, you'll find that this one will be just direct. Goodwill, maybe you'll have to compute. Investment in social media at times will be given direct. Other investment, you'll be able to identify that one very easily, assuming you've earned this mark, direct mark, maybe direct mark. This one, UPS, that one won't take you time. Direct mark, direct mark. NCI, have your workings there. Retained earnings, have your workings. Trade payable, direct mark. So you'll find that this one direct. So you'll find that you're talking of 1, 2, 3, 4, 5, 6, 7, 8, almost 9, 10. Almost 10 marks that you're having for that you'll be having. Maybe this one it can earn you 3 to give you 16 points. So you'll find that passing FR is always very easy. Once you have the format at the back of your mind, you can always work it out and things will always be very, very easy on our end. So to this point, guys, thank you so much. In our next class, we are going to look at another concept of consideration, where we are talking of what? Share to share exchange. Very common nowadays. You can check question in April last sitting, they tested that concept. The other sittings, sometimes in 2021, they shared that concept. So you'll find that that is very, very important for us to always know, naming our aspect of consideration. So at this point, guys, thank you so much and see you then. God bless.